Hello, everyone, and welcome to another episode of Selling Greenville, your favorite real estate podcast here in Greenville, South Carolina. I'm your host, as always, Stan McCune, realtor right here in Greenville, South Carolina. You can find all of my contact information in the show notes if you need to reach out to me for any of your real estate needs. Just a reminder, as always, please like this. Like, if you're on YouTube, just look real quick at your phone and hit the little thumbs up button. Or if you're watching on a computer, same thing. It takes 1 second to do it. If you haven't subscribed, please subscribe. If you can leave a rating or a review on whatever podcast app you are listening to this on, please do that as well. And thank you guys so much for listening. Again, I really appreciate all of my listeners. I've been doing this show now for nearly 6 years. It's kind of hard to believe. Over 300 episodes. It's crazy. Not very many shows make it this long, but you guys, I've got a lot of devoted listeners, and you guys are the ones that I do this for. And so thank you very much. So we survived snowpocalypse, first ice apocalypse. We had a couple weekends ago, a lot of ice. Some of the ice still hasn't even melted. Like in my driveway, some of it still hasn't even melted. It's not a big deal. I'm not really worried about it. I prefer not to put salt down in my driveway because I have a creek on my property and it just washes away into the creek. Really bad for the environment, so I really try not to do that. But the ice is fine. But then we got snow. We got, at my house, probably about 5-ish inches of snow. It's pretty much all melted by now. But that came through over the weekend. So we've had 2 straight weekends of winter weather in Greenville. After earlier in January, we had some days that were in the 70s. So we've had pretty much all 4 seasons, well, maybe not summer, but basically the equivalent of 2 to 3 seasons just in the month of January. It's been incredible. And here we are now in February. And I can't believe already the first month of the year is behind us. If you are a realtor listening to this, I have something to let you guys know about. The Realtor Political Action Committee, which I am very involved with. I chaired that committee the past 2 years. I am no longer chairing it, but I'm still on the committee, still very heavily involved. We have an event for basically major investors, people that are pledging to donate $1,000 or more towards RPAC in this calendar year. We have an event on February the 19th, 4:30 to 6:30 at the City Club. You have to RSVP for it. And you don't have to, it's a free event where you can show up even if you're not sure that you want to pledge to be a major investor. And so it's worthwhile. There will be some hors d'oeuvres, some drinks. Highly, highly recommend if you're a realtor that you go to that. And if you're not a realtor, unfortunately, unless you're an affiliate member, you cannot attend an event like that. Due to federal guidelines. So anyway, reach out to me. Again, my contact info is in the show notes. If you don't have it, reach out to me if you're interested in that. I'm going to put my phone on silent here because I just felt my watch vibrate, which means I don't have my phone on silent. All right. So all of that housekeeping out of the way, we need to talk about some current events. Now, I always tell you guys when I talk about national events, this is always through a Greenville lens. This is going to be a little bit more national than I typically prefer to go with this show, but this is very important. President Trump, we've been talking about the Federal Reserve for quite some time and the relationship with President Trump. And I've discussed it extensively on the show about specifically how the Federal Reserve and Trump are having a bit of a war. Specifically, Trump has had a war now for over a year with Federal Reserve Chair Jerome Powell, and we've discussed this war extensively for good reason, because the Federal Reserve has huge control over our economy, and what they do ultimately with the Fed funds rate often has direct implications for mortgage rates. Again, we've talked about all this in the past, so you can go back and listen. Just search for Federal Reserve in the search bar of this show, and you will find a lot of episodes that I've done on this. Of course, with the Federal Reserve having a lot of control over where mortgage rates are, that's important because in case you haven't been paying attention, mortgage rates are everything in real estate right now, something we've also talked about a lot on the show. So for quite some time now, President Trump has been gearing up for replacing Jerome Powell, whose term as chair over the Federal Reserve ends this year. And he's been talking extensively, Trump has, about how he's going to bring someone in as chair who will bring rates lower. Now, for a long time, people assumed it would be Kevin Hassett, one of Trump's economic advisors. But a few weeks ago, Trump said, really just in an offhand comment, it was kind of funny, that he wanted to keep Hassett in his current role. And even though Trump didn't directly address the Fed chair rumors in that comment, the markets immediately responded. Not in a good way, because the assumption was Hassett was going to bring down rates. Well, once Trump said that it's not going to be Hassett, the other options that basically are there are other potential people that probably won't drop rates to the extent that Hassett would. And so that sent a market response. They didn't like that. The 10-year yield went up, mortgage rates went up, and really all bond yields went up. And so, as what always happens, mortgage rates are tied to the bond market. And so when the 10-year yield went up, mortgage rates also went up with them. And now, I don't want to oversimplify this. Bond yields have gone up for some other reasons recently. And it's not all because of the comment about Hassett. But there was a very clear immediate market response. I mean, it was funny when you track it, the timing of when Trump's comment made it out on the internet. It's the exact timing that the bond market responded. So basically the bond market concluded that if it wasn't going to be Hassett, who is expected to lower rates, then it's going to be someone who won't lower rates as much. And so bond traders, having been banking on lower rates coming, readjusted, sold off bonds, causing yields to go up. Okay, that's basically what happened. And as I already said, mortgage rates shot up with them. Remember, a few weeks ago, we discussed how Trump said he would direct Fannie and Freddie Mac to buy mortgage-backed securities. And that caused mortgage rates to go from the 6.2s all the way down to, at one point, 5.99, right? That wasn't that long ago, just a few weeks ago. Well, the Hassett news shot mortgage rates right back up to the 6.2s after they had been, spending a good bit of time in hovering right around 6.0. They shot right back up to the 6.2s. And I've even heard since then that some people thought maybe Trump knew the Hassett news wouldn't be taken the best way. And so he made the Fannie and Freddie announcement when he did in order to blunt the effect of the fact that he was choosing someone other than Kevin Hassett. I don't know. That seems maybe like a bit of a stretch, but it's possible, right? We don't know what sort of advice the president is getting. I do know that he seems a lot more impulsive than he is, having talked to people that are a part of his administration. It seems like a lot of the things that he does is not calculated, and I think that there could be some truth to that, but I don't think it's fully to the extent that that the media wants you to believe. I think that there is a lot going on behind closed doors. Regardless, people have been speculating on who Trump was going to pick since it wasn't going to be Hassett, and then a few days ago it became clear that Kevin Warsh was the front runner. Now, Warsh served on the Federal Reserve as a Fed governor from 2006 to 2011, so he already has experience in the Fed, so we can look at what he did. And not only was he a Fed governor, which is good, right, from the standpoint of us having a track record to look at, but if you were paying attention there, it was from 2006 to 2011. That was right smack in the prior to the global financial crisis and during it. So he has a track record during a very interesting time. Now, the thing that he is most known for is that during that global financial crisis, when inflation was super low, inflation was about a third of what it is currently. I mean, it was minuscule. And unemployment was super high, over double what it currently is. Warsh famously said that he wanted to increase rates to make sure inflation didn't take off because he wasn't concerned about unemployment. Unemployment was at 9% at the time. Inflation was at 0.8%. Okay, so again, unemployment super high, right? It's in the low fours right now. Inflation super low, right? It was back then. Unemployment back then 9%. Now it's in the fours. Inflation right now probably like 2.5%, something like that. Maybe a little bit higher than that, closer to 3%. And it was at 0.8%. Okay, And he was saying that he was more concerned about inflation than unemployment, which is absolutely asinine. That's an awful, awful thing to have on your track record as someone sitting on the Federal Reserve during the worst recession of a generation, of multiple generations, to be honest. And his concerns ended up being completely ill-founded. Inflation did not go up during the global financial crisis. Unemployment did continue to go up during the global financial crisis. And so he was entirely wrong on both points during one of the biggest economic crises in U.S. history. So that's not great. And in general, he has been considered a hawkish Fed governor, okay? Someone who is hawkish is someone that wants higher rates. Again, that's what he wanted during the global financial crisis, when that would have been devastating. It would have been devastating to the economy to add high rates on top of all the other awful things that were going on. Some of this hawkish wants the higher rates versus, if you ever hear the term dovish with regard to the Federal Reserve, as someone who is dovish is someone who believes in lowering rates. Okay, I'm oversimplifying things. This is a podcast, right? Heavy orality, if you know what that word means in this podcast. But what I'm saying is correct. It's just simplifying it. So, very interesting selection by President Trump. That wouldn't have been who I would have selected. I would have selected Fed Governor Waller if it had been me, to accomplish what the president wanted to accomplish. But perhaps he felt like he has more direct say over Warsh, perhaps. Maybe he feels like, I don't know. We don't exactly know what all was going into the president's thinking. And as a result, there's been a lot of reactions to this. All right. So from the standpoint of Warsh being impartial and someone who would do what is best for the economy rather than what's best for the president, most think Warsh would be pretty independent, which is good, right? We've talked about this before. We want the Federal Reserve to, generally speaking, be independent. We don't want them to change monetary policy simply because the president wants them to. They need to be assessing the economy for what the economy is and making the best decision for our country independent of the president, because presidents are elected officials every 4 years, and they might want to basically juice the economy in an unhealthy way. We don't want that to happen. However, there is some concern that Warsh has become more dovish in what he has said the past year, right? So he's traditionally been considered a hawkish Federal Reserve member, a hawkish economist. Suddenly he's pivoted to being more dovish the past year. Well, what has happened the past year? Well, one thing we know is that President Trump came into office. So is Warsh actually independent, or has he been changing his tune just because he wanted to be the Fed chair? This is a concern that some other people have. And there's also some concern that because Warsh has flip-flopped recently as his tone has become more dovish, that his colleagues on the Federal Reserve might not respect him and he may struggle to garner votes. You've got to remember here that the Federal Reserve is more than just one person. The Fed chair doesn't decide rates or any of these things unilaterally. There are 12 voting members on the committee who decide what should happen to rates. The Fed chair's job is to herd the voting cats in the right direction. And if they don't respect him, right, if they think he's flip-flopping, he doesn't stand for anything, he's just doing what the president wants, will he be able to herd those cats? I don't know. I seriously, I have some serious questions, and so do many other experts, because these people that serve on the Federal Reserve, they're stubborn and prideful, and it's hard to get consensus among them in the way that Chair Powell has done the past, 12 years? It's really rare to get that sort of consensus. And as far as markets are concerned, this is maybe the most interesting thing. There really hasn't been a large response, right? You had the response after Hassett was ruled out, where the bond market basically was like, oh crap, we're not going to have Hassett. Rates might not go as low as we expected, and so then the bond market immediately priced in someone who's going to potentially increase rates, or maybe not increase rates, but not lower them at the rate that Hassett may have. And so when it came out, when Trump announced on Truth Social that Warsh was going to be the new Fed chair, the markets had already priced that in. So Treasury yields, mortgage rates really didn't go up at all. Really nothing happened. And that's good, right? I'm thankful that there wasn't a huge swing in that the markets were kind of like, okay, this makes sense. But this could have a huge impact later this year, right? Because most agree that more rate cuts need to happen at some point. Will Warsh want that? And will the committee agree to do it if he pushes for it? Again, more questions than answers when it comes to what Warsh actually stands for now and whether he'll be able to get this committee behind him with wherever he lands on all of this. Additionally, will the bond market agree with the Federal Reserve if rates get cut, right? So Warsh, if we want mortgage rates to go down, we need several things to happen. Some of these things have already happened, which we've talked about in the past. But we need the bond market and Treasury yields specifically. We need Treasury yields to come down, right? We've already talked about that. But oftentimes Treasury yields follow what the Federal Reserve is doing. But there has been a divergence recently. The past few rate cuts that the Federal Reserve has caused Treasury yields actually to go up. And there's a variety of reasons for that. But the long story short is the bond market has to agree with the Federal Reserve. And if they don't agree, so let's say, for instance, the Federal Reserve cuts rates and bond traders think they're going way too aggressive, they're trying to juice the economy, they're going to send inflation skyrocketing, then they're going to sell off their bonds and T-bills. And the end result would be in that situation that they disagree with the Fed and mortgage rates would end up going up in that sort of an environment. And we talked about this quite a bit. If that were to happen, then we could see a situation where the 30-year fixed rate mortgage and adjustable rate mortgages end up having a really big gap between them because ARMs, adjustable rate mortgages, are directly tied to the Fed funds rate, whereas the 30-year fixed rate mortgage is directly tied to, or indirectly tied to, Treasury yields. Okay? Are you following? I hope you guys are following all of that. In fact, one of my bold predictions was related to the spread between the 30-year fixed rate mortgage and the adjustable rate mortgage. Let me see what that spread looks like today. Actually, I'm going to pull this up real quick on my computer. So as a bank rate, what bank rate is saying is that the 30-year fixed rate on bank rate 6.16%, the 5-year ARM 5.44%. So that's a decent gap, not a huge gap. We'll continue to monitor that. Now, another thing we need to talk about here is that there could be some drama here still with regard to the Federal Reserve beyond what I've already said, because technically Chair Powell could stay on the Federal Reserve as a voting member even though he will no longer be chair. Because he has been in a bit of an open war with President Trump lately, some speculate he may stay on just to spite Trump. Would not surprise me. That would be highly, highly irregular, but it would not surprise me because if you remember, he made a scathing statement about the president recently, and he's being sued by the Department of Justice and all sorts of stuff. So nothing would surprise me at this point. If he did stay on board, he could seriously undermine Kevin Warsh, and I suspect he would if he felt like Warsh was influenced directly by Trump. And remember, the current voting members on the Fed really respect Chair Powell, and they could very easily form a coup against Warsh if they didn't like the direction Warsh wanted to go in. So this is all there's a lot of moving parts here, and a lot of stuff that could go right or wrong. And it all has major implications for mortgage rates and for the housing market, specifically here in Greenville, right? Because as I've said in a recent episode, we need mortgage rates really around 5% in our market to see the market return back to something that resembles normal for Greenville. I think even going down to 5.5% would make a huge difference. But right now, this is all in jeopardy because of all of the chaos at the Federal Reserve and chaos in the bond market. This chaos started with the tariffs, and it's simply just continued. It hasn't stopped. Now, the tariff talk has calmed down, but we're still hearing some of it. It's just not as crazy as before. So it's not really impacting the market as much, but it had a huge impact last year. So I think we can expect the end result of all of this, really, unfortunately, to be higher rates for the 30-year fixed rate mortgage this year. We may not see it go into the fives again unless the economy really starts to show signs of breaking, right? That's what causes treasury yields to come down. Usually. When unemployment starts to go up, or or other signs of economic weakening happen, then usually people try to go to safe assets, and usually treasury bonds are considered a safe, very safe asset. And so when they buy treasury bonds, that brings the treasury yield down, and then usually mortgage rates come down as well. So in the absence of that happening, the economy kind of going in the tank, like more so than it currently is, I think people just need to be prepared that we might just be stuck in this low 6% mortgage rate environment for most, if not all, of 2026. Now, we do have elections later this year, right? It's a midterm year. We don't know what impact that will have. I have no idea what impact that will have. That can go a whole lot of different directions. And so we're going to track all of this. I'm going to track all of it for you guys. I'm going to be telling you guys how it will impact the Greenville real estate market. I will tell you this. The past 2 weeks in Greenville have been slow because of all these storms, right? When we get ice, when we get snow, it shuts the city down, shuts the county down for several days. So now we've had 2 straight weekends that have been completely shut down as a result of winter weather, which is pretty rare. And so who knows what implications that will have. But it's been an odd start to the year. We'll just say that. A very odd start to the year so far. But it's also been kind of nice to get a little bit of time off as we've had this winter weather. So I'm not going to complain about it. It's easy as a realtor to complain when you're busy, when you're super busy, and to complain when you're super slow. I'm choosing not to do that. I'm simply going to enjoy the busyness. I'm going to enjoy the slowness. I'm going to enjoy whatever comes my way. I'm going to enjoy high rates. I'm going to enjoy low rates. I'm going to enjoy Chair Powell. I'm going to enjoy Chair Warsh. We're going to enjoy all the things. So thank you guys so much for listening. That's all for today's episode. Please like, rate, review, subscribe. Find my contact info in the show notes if you need a realtor in the Greenville area. We will talk to you guys again next time.